Hello, good morning. I am Avnish Jain. Welcome to this monthly debt outlook from Canara Robeco. As usual, let us start from the geopolitical angle. Geopolitics quietened down a bit after a ceasefire was brokered by the US between Israel and Hamas. Though there have been several flare-ups between the two sides, the ceasefire is holding as of now. On the other side, the Russia-Ukraine war continues without any respite, despite efforts by US and the European Union to bring Russian President Vladimir Putin and Ukraine President Zelensky on the negotiating table. So far, it has not worked out. Now, the European Union is looking to add more firepower to Ukraine as the US has brought down their support to Ukraine in a direct form. Looking at macroeconomic factors, the US trade deals with various global partners seems to be again stalling. While a flurry of deals were announced in the last few months, the details are confounding both sides. There is yet a concrete deal to be reached with large countries like European Union and Japan with the US, as the details are still being worked out within the two negotiating parties. Coming to rates, the US Federal Reserve cut rates in the last policy in September and is likely to cut again rates. Though inflation remains on the higher side, the growth numbers have been coming down, and the US Federal Reserve has pointed out that the risk of growth slowdown now is more than the inflation outlook. However, with the US shutdown, meaning that because of lack of funds not being approved by the US Congress and Senate, the spending of the US government has reached the ceiling, and beyond that, the US government cannot spend money. To that extent, the US government federal employees have been furloughed or given temporary leave till the shutdown continues. The shutdown is now into its fourth week, and we have to wait and see how long it drags on. This impacts data availability in the US, and US Federal Reserve will also find it difficult to reach conclusion where the latest data is not available to the researchers. Despite that, the federal policy scheduled for 29th of October, late night for Indian Standard Time, the US Federal Reserve is expected to cut rates by 25 basis points. The US Federal Reserve chairman may point out that this because of unavailability of data, the Fed cannot give further guidance, and for future policy moves will remain data dependent. The markets have taken all these actions in the last few months as positive. We have seen US 10-year drop from about 4.2 at the start of October to below 4% now at October end. Other countries are also experiencing lower rates on back of dovishness in the US policy. Oil prices, which had gone higher, have also reversed trend on increased supply from the OPEC plus country, especially Saudi Arabia has increased production in the last few months. Coming to India, Indian economic continues to be resilient despite global headwinds. The GDP growth for the first quarter of FY26 came at 7.8%, which was much more than the consensus forecast of about 6.6%. Lately also, IMF has increased its projection for the GDP growth for FY26 to 6.6%. So overall, Indian economy will continue to grow the fastest in the world, despite all the global headwinds. And especially since we have also seen a 50% tariffs being imposed by US on Indian exports. Indian team continues to negotiate with the US trade team on these issues, and a conclusion is expected in the near future, hopefully. On the rates, when we come to RBI policy has been in status quo mode since the start of this financial year. In the latest policy, RBI sounded dovish. This was because inflation has been dropping month by month, and the latest number printed in September was 1.54%. To that extent, RBI had to revise its forecast downwards of inflation for FY26 from 3.1% to 2.6%. Despite that, RBI chose to keep rates in a status quo mode and did not change the stance from neutral. However, the governor pointed out in the press conference that there was limited room for more easing, and now markets expect an rate easing move in December policy. Overall, the market recovered from the highs we saw in August after President Trump put 50% tariff on Indian exports, and also GST rate cuts were announced by the Prime Minister. However, the GST rate cuts announced in September, the final rates which were announced in September, are likely to impact inflation downwards. That means inflation will go down as a large proportion of products have moved from 28% to 18% and 18% have moved to 5%. And a lot of products have also become 0% GST. To that extent, the consumers will benefit from lower rates, which we have also seen in a large jump in consumption during the festival time. Overall, RBI has a tough task. The global headwinds are strong and uncertain. And while there is opportunity to cut rates, RBI will be carefully watching the inflation growth trajectory and also global events before taking the next step. In terms of market movement, 10-year yield, which touched a high of 6.65 approximately in August, has now slipped to around 645, 650 level. Due to market expectations of only one single rate cut, there is no expectation that there will be a huge rally in rates, meaning rates will drop very fast. Market are still expecting RBI to use other tools to inject further liquidity in the system, which has been now gone into deficit post-festival season. Overall, markets remain lackluster and moving sideways. As the date of the policy nears, we should see some market activity. Overall, FI inflows in India have been tepid, but they have been positive in this calendar year. So overall, we have seen participation from foreign investors, though it has been lower than last year. Overall, the market movement is expected to remain sideways. We do not anticipate any major rally in rates. To that extent, we don't see a big play in the duration funds. Investors may choose to allocate to short and medium term funds like short duration fund, corporate bond fund, and banking and PSU debt funds. As always, investors should look at their investment horizon and the risk appetite before investing in debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.